been, the first version of this paper was from 2014, so it's been quite a long, right? It's had a long publication process, but it looks like it's gonna finally come hopefully soon at the Journal of Finance. But just to let you know, if you've seen older versions, it's changed slowly over time, although not that much. So what was the motivation? I should say was, because again, it's a little while ago, but what was the motivation for this paper? The motivation is whether one should be taxing financial transactions. And this is a topic that, emerges periodically whenever there's some kind of financial instability. As you may or may not know, the notion of transaction tax is often associated with Tobin. There's this famous Tobin speech in 1972. In fact, some people call these taxes Tobin taxes. But the idea of putting some kind of transaction tax in financial markets, is often traced back to Keynes, who has this expression like throwing sand in the wheels of the financial system. Okay, there's some work by Stiglitz and Summers, mostly verbal. This is all like, there's no formalization of these ideas. In '89, that's right after the '87 stock market crash. And in a way, there was a strong push for this. In particular, the European Union actually discussed a transaction tax very seriously. France and Italy, they actually implemented one. And there were other experiences. If you look at the paper, there's some discussion of Sweden had one, was somewhat of a failure for them, and so on. So there's been always discussion over time, but for one reason or another, there's very, very little formal analysis on this topic. Okay, and part of the challenge, in a sense, was to come up with a fully internally consistent theory of why one may want to actually tax financial transactions. And this paper is going to provide a theory of transaction taxes, and it's going to be driven by the presence of non-fundamental trading in financial markets driven by heterogeneous beliefs. Okay, so in the model I'm going to show you in a second, financial markets are going to play two roles. On the one hand, they're going to allow for fundamental trading, and I'm going to be very precise about this. So it's going to be trading driven by different risk aversion, different hedging needs, different initial positions. That's going to be one role, and there's going to be a second role, which is going to be this trade that is driven by heterogeneous beliefs. And that component, when associated with a planner that computes well for using a single belief, and that's what the notion of paternalism that this planner is going to be using, it's going to provide a rationale for taxing financial transactions. Okay, and that's really what the paper is about. And in this world, there's going to be scope for a tax, and I'm going to tell you how the tax gets characterized, what does it depend on, how you could potentially come up with a sensible number. Okay, so that is kind of really the idea the paper brings. And again, the challenge again is to have this internally consistent theory in which there's a rationale for transaction tax. That was really the key contribution of the paper. Now, let me give you a preview of the results, and I'm just going to kind of jump in and tell you the structure of the paper. I'm going to start describing the environment. So there's three main results in the paper. So the first one is this optimal tax formula characterization. So I don't know how familiar you are with optimal taxation theory, but this is going to be an optimal taxation theory exercise. Okay, in the same way that you can do, for example, Ramsey taxation for commodities and so on, or you could do capital taxation or income taxation. This is going to be an optimal taxation exercise. So I'm going to give you an optimal tax formula characterization, and I'm going to show you that the optimal tax is eminently a function of investors' beliefs. There's going to be also this demand elasticity showing up. I'm going to explain to you why that is the case. Second, I'm going to provide a characterization of the sign of the optimal tax in this model. Okay, so without making, I start characterizing the model for general fundamental and non-fundamental motives for trade, and then I tell you under which conditions a positive tax is optimal, and I'm going to give you a sufficient condition for that to be the case. And the sufficient condition will be that the beliefs and other reasons for trade have to be orthogonal across the population. I want to explain what result emerges, and in that case, you want to have the positive tax. By this, I also mean like there are conditions in which a subsidy might be optimal, and I'll explain to you why that could be the case. Okay. And the third main result, that's perhaps the most surprising one, is that I'm going to show that the optimal tax is independent of the planner's beliefs. As I said, the planner will compute the welfare of each individual by using the planner's belief. And I'll discuss a bit how the planner's beliefs could determine, but I don't want to take a stance in the paper. I want to compute the optimal tax given a belief. And what I actually show is that for the optimal tax, the planner's belief doesn't matter. And this is an important observation, and it addresses some conceptual issues. So I'll talk also about this. Now, the paper has a number of results after all these years. So, I'm going to show you that the Planner's problem is non-convex. I should say the objective is not quasi-concave. Okay, so there may be kind of multiple optima, which is kind of interesting. There is, I'm going to provide a second set of results in which one can implement the optimal tax looking at trading volume. I'm going to show how that gets that. And then I'm also going to show how one can provide a simple approximation to the optimal tax using laissez-faire information. Okay. Now, I'm also going to, later on, I'm going to specialize a bit more in the economy and give you some comparative statics on beliefs. And then I'm going to walk you through how you can quantify this and how this works in practice. So a rule of thumb, this is an approximate rule of thumb. I can have exact results that I'll show you. But essentially, given the elasticities that were estimated for the case of France, a rule of thumb is if you think that in the economy, the share of non-fundamental volume, or the share of belief-driven volume is something like 20%, you want to put a tax that is 20 basis points. This is kind of the back of the envelope number that you get. And of course, there are a number of caveats, and some of the extensions deal with this. Okay, and we can have a discussion. So I don't want you to take very seriously. I want you to take seriously quantification, but be aware that there are a number of caveats that go with that. For example, there's no leakage, so investors cannot go trade somewhere else and so on. That may really lower that number quite a bit. So it's more of a again, one needs to be careful with the numbers. So what I'm going to do in the talk is I'm going to describe them all to you. I'm going to tell you the positive analysis. Then I'm going to tell you the welfare criterion, and I'm going to give you the main results, which are these normative results. And then again, I'm going to talk about the volume implementation, the convexity result, give you the comparative statics and the quantification, and then if I have time, which I may not, I may describe briefly my extension. So I'm just going to jump into them all, and feel free to ask me questions if anything is unclear. So there are two periods. Okay, so it's date 1 and date 2, and there's a single trading stage. Again, I'm giving you a very simple model. If you think about dynamics and all these issues, the appendix has more stuff, but I'm going to walk mostly in this in the talk. I'm essentially going to only talk about this 2-period setup. So you have today and tomorrow, and there's a single trading stage. There's going to be a distribution of investors, which is f of I. So I is the identity of the different investor, and then f is going to be the distribution of each, essentially, type I investor. And then they're going to have Cara utility. There's going to be a coefficient of risk aversion AI. That's absolute risk aversion for the investor. And there are going to be 2 assets in the economy. And there's no short sales or borrowing constraints. So they're going to be unrestricted portfolios they can take. So there's a riskless asset with gross return R equals to 1. This one is elastic supply, and then endowment is 0. So this is just this technology you can borrow and save. It's kind of quite a standard in this literature. What it's important is the risky asset has a price, P1, that we're going to assume it's positive. We can make assumptions that is always the case, has fixed supply, and pays a random dividend D. Okay, so D is going to be random at day 2. Now, investors have some initial position, this X not I, and the key choice is going to be the X. It's going to be the X1I that they have to make. Okay, so that's how the asset structure works. And what is critical is that each investor is going to have its own heterogeneous belief, okay, about the distribution of this D. All right, so investor I will oh, sorry, I hope you can hear me well. I hear something weird. So if each investor is going to have each investor I is going to perceive that the distribution of beliefs takes the following form. Okay, so it's going to be a normal with some mean and some variance. Now, what I'll be assuming is that each investor has a different mean. It's going to be a different mean perception about what the distribution of payoffs of the risky asset is. Okay, so I'm going to assume for that the variances are the same. This is something that can be easily relaxed, and I'll do this later on. But for the talk, we're only going to focus on the mean, and I'm going to show you that. I'm going to try to argue that this is the first order effect. It's a difference in means going to have a bigger effect than the difference in other moments and so on. Okay, so that is this is critical. Okay, so keep that in mind. It's going to be a difference in how they perceive the expected payoff of the asset, and then on top of this, they're going to have a stochastic endowment E to I that is correlated with D, Okay, and this covariance is going to be agent specific, and it's also going to be potentially varying. Okay, so this covariance means that if the covariance of your endowment with the payoff is positive, this asset is especially risky. So for hedging motives, you would like to buy less of it. If this covariance is negative, the asset is a hedge given your endowment, so you want to buy a bit more of it. Okay, so why did I highlight with blue all those 4 objects? Because those give you the 4 reasons to trade in this setup. Okay, so agents will trade because they have different hedging needs. Agents will trade because they have different risk aversion. Agents will trade because they have potentially different initial asset holdings. And all these 4 I call fundamental, I guess, and what I call non-fundamental, that's why my terminology is going to be the trades that are driven by the difference in beliefs. Again, this is really, this is really the part that's going to be non-fundamental, and this was going to be driving the main results. Now, keep in mind that for positive purpose, from the purpose of describing the economy, all 4, you can think of them as equivalent. So at this point, there's no difference. The difference is going to come later on when I make some assumption of how welfare is computed. But I want to just kind of make sure you understand why people will trade here and why beliefs might be special. But you need to wait a few slides to understand why. Okay, but this is the environment. Now, I haven't told you about the tax. So the whole point of the paper is to think about the tax. So this environment will be fine without a tax. Now, if there is a tax, I'm going to assume that agents face a linear anonymous tax. Okay, and this is going to be paid by buyers and sellers on the dollar value of the transaction. Okay, so formally, I have the constraint here, having the next slide doesn't matter. So essentially, if you trade, let's say 10 shares, and each shares is worth $2, so that's a $20 trade. And if the tax is, let's say, to make it easy, 1%, okay, 1% of $20 might be 20 cents. So if it were 10%, it would be $2. Okay, so it's just you look at the dollar value of the trade, and then it's some fraction of that, and that's how it's going to be. It's paid by both buyers and sellers. It's something also I relax later on. You can make the symmetric and so on. There's a sense to make it symmetric, but that's the way it's going to work out. So revenue is going to be 2 times because both buyers and sellers pay the amount, and then you have the tax rate times the dollar value times the number of shares being traded. That's an absolute value there. Okay, and 2 things you should keep in mind. First of all, there's no tax avoidance. By this I mean, if investors, the options of investors are to trade or not to trade. There's no venue, there's no extra venue in which they can trade. Again, this is something that I address a bit in the extensions. Actually, I think that in the final version of the paper, there may be a bit more work on that, but that's kind of important. Okay, if you had avoidance, what I did, it would be fine, but you have to kind of correct for that a bit, so you're going to get a lower number at the end, but nothing will change from the conceptual view. And then for simplicity, actually, I'm not quite assuming this anymore, but a nice way to think about it is like, the rebate, everybody gets rebated the same amount. You don't really need this. All you need is that money gets rebated on aggregate to everybody. Okay, and because everything's sort of linear, nothing's gonna change. Okay, so I think some of the questions I may show, they may assume this, but actually in the proofs, I don't need it. So all that you need is that the money gets rebated back and not wasted. Okay, that's kind of important. And given this, the equilibrium definition will be a competitive equilibrium with taxes. It's all fully standard, well-rationed. It's a well-rationed notion, so there's nothing special about it. So let me start to walk you through the problem, okay, a bit more formally. So an investor will be solving this problem. They're going to maximize over the portfolio decision, which here is just the amount of the risky asset, the expected utility. Because of the Cara assumption, this problem becomes mean variance, and the whole.
Sorry for interruption, Ecuador. I think Martin, we have a question.
Yes, sorry. Go ahead, please.
Yeah, and so this rebate. So the investors, they don't take that into account for the optimization problem.
Mm-hmm. They don't, correct.
So what is the economic rationale for that? Because if I know that I get the rebate, surely I should take that into account in my investment.
Yeah, don't worry about that. Assume that the rebate is, this is the usual assumption that if you're small, you're facing the tax, but you get a lump sum rebate at the end. And if that bothers you, think it's fully arbitrary, that you'll get some amount, but forget about the assumption that I just mentioned to you. Just say that on average, you send the money back in checks, and let's say you get random amounts, and that would be perfectly fine with everything. That is just because it's just to make some, I don't need it. Actually, I had it originally. I was kind of forced to drop it, and I dropped it, and everything now doesn't need that. So if you feel better, just think of you get some random check at the end, and that will all go through in a sense. Because conceptually, it's just, so conceptually, the notion is like, when you do this, there's a bit of a distributional issue. For example, if you trade a lot and then you don't get as much rebate, there's going to be an issue. And for some of the results that I won't actually show today, you want to kind of cleanly identify what is the distortion coming from your changing portfolio. And then there's all this like revenue transfer that's going on. But from the welfare analysis, as long as you rebate the whole money as a whole, that's fine.
Thank you.
And you can also think that there's other people in the economy which we don't mull and they get the money, and that would be kind of fine. But yeah, that's the rationale. In these setups, in these corrective problems, you need to do something with the money. So one sensible assumption usually is just kind of send it back. But there's other literature thinking, for example, I don't know if you're familiar with this. There's a literature called a double dividend in environmental externalities and so on, in which actually, this is a good point to make this argument actually. Like, a lot of the debate in practice about Tobin tax is about the money being raised, and this paper has nothing to say much about that. And economists, what you do with the money is a separate problem. The fact that you raise it is maybe useful actually. So yeah, but that is a bit of a separate problem. That is about you need to raise money, and what's the best way to do it. That is a problem that has not been explored actually that much. There are results that suggest that this might not be a good idea, but it's not what the paper is about. This paper is really about thinking people are making these wrong trades based on their beliefs, and you want to curtail that, and that's what the theory is going to have described. That's a very important point. So okay, awesome. So please interrupt me. I'm going to actually put your to my view so I can stop. So the wealth day 2 is this W. Okay, you get the endowment, you get your allocation of asset shares. This is the dividend payment, and this is the amount that you are essentially. This amount is what you invest in the risk-free asset. Actually, I think here I wrote R equals 1 just for simplicity, but essentially, this is what you had initially, and this is quite standard if you've worked with these problems, which you may have. So that you get there, just because the problem is to be the simplest possible difference is the blue part. That's why I'm highlighting that over there. It's the tax plus the rebate. Now, if you solve this problem, you're going to find the following asset demand. This is again completely standard in this setup. So this is in deltas, the change in demand is going to have the usual components, the expected payoff minus the hedging term minus the price, and this is coming from the quadratic term. And this is the initial position. What is different is always highlighting blue. So if you're a buyer, you're gonna perceive a higher price, so you get a 1 plus tau. If you're a seller, you're gonna perceive a lower price, so you get 1 minus tau. And if you're in this setup, you get inaction, okay, which means there exists a region in which you don't trade. What I mean by buying is this thing has to be positive, this thing has to be negative. So let me I'm just going to jump here. This is how the demand will look like on the price. Okay, so there's a region in which you don't trade. If the price gets really low, you start to become a buyer. Okay, so X1 starts to be higher. If the price gets really high, you will think that the asset's not very good. You're going to become a net seller. Okay, this is kind of how demand looks like. And then once you have the demand, you can integrate over everybody. You're going to get an equilibrium price P1. Okay, so again, this is quite standard. Now, there's an expression for P1 that is in the paper that is essentially kind of aggregating all of this. Is not particularly insightful, so I'm kind of going to summarize here what are the key points. I can show that there's always going to be an equilibrium for a given tax in this setup. So take the tax as given, you always can find equilibrium. The equilibrium is essentially unique. So let me tell you what I mean by essentially. Essentially means that the allocations are fully pinned down always. Okay, the stuff in which there's a bit of a dimension of indeterminacy is that it can be the case that there is no trade. Okay, so if the tax is very, very big, you can think of a world in which there's just no trade, and there's going to be then a range of prices that will support no trade. okay? But for small tax, and again, if you make reasonable assumptions on the primitives, you're gonna have an equilibrium, it's gonna be unique. If you go crazy on the tax, you maybe nobody trades at all. And in that case, there's a bit of a range of prices consistent, but allocations are uniquely pinned down. Now, you shouldn't be surprised really that this thing is unique and that it exists, because in this setup, you only have substitution effects really kicking in. This thing has no income effects, so everything's like nicely well behaved. So that's kind of the intuition for why you get existence and uniqueness. Now, second result, which may or may not be that surprising, is trading volume, which I will define formally in a few slides, but it's just, it's the usual definition of trading volume is the number of shares being traded. It's going to be decreasing in the tax, okay? It is not necessarily true that everybody's, here, because, you have kind of different effects. It's not that there's no income effects. The income effects are not strong enough, so you may have differentials, but you can show that trading volume turns out to be decreasing in tau. This is very natural. And the price response is the thing that is perhaps the more interesting, which is like you can show that the asset price can be increasing or decreasing with a tax, okay? And people tend to have an intuition sometimes, which is wrong, which is that when you put a tax, prices go down, but it's not true. In fact, prices can go up. And the logic is the following. If you are a buyer and you face a tax, you're gonna buy less. But if you're a seller and you face a tax, you're also gonna sell less. Okay, so it goes both ways. And actually, you can easily show that it depends on you can call it demand, aggregate demand side elasticity and aggregate supply side elasticity. That's what's going to be driving whether the price goes up and down. Now, there's a nice assumption that I'll make sometimes because it gives very nice results. It's what I call symmetry. So symmetry means if everybody has the same risk aversion and the other reasons for trade are symmetric, okay, in the usual definition of symmetric, okay, you have an axis and then it's the same to both sides, then dp1 d tau is 0. And the intuition there is if the thing is symmetric, you have buyers on the one hand, sellers on the other side, and you start to put a tax, you're kind of moving the buying and the selling pressure in the same way, so you can kind of keep the price not moving. Okay, and that's, volume will go down, but the price will remain constant. So that's like quite a nice benchmark in this setup. So personally, this is an important result because a lot of the verbal arguments, Tobin and Keynes and Stiglitz and all those people, they tend to focus on price volatility, but it's not obvious. In fact, this is a static setup, but it doesn't take a lot of thinking to realize that in a dynamic setup, you can get volatility going up and volatility going down. And a lot of the empirical work actually shows that is the case. You have a lot of mixed evidence, which is sometimes seen as a puzzle, but it's not a puzzle really. It's just once you understand what's driving this, it's the price, you may get both results. Okay, so I went a bit fast here. I went a bit more verbal because I wanted to focus on the normative results and the key contribution of the paper. So the key question is, how do you assess welfare here? And this was, this has been a bit of an open question. I think now since this paper came up and there's much more work on these issues, but how do you think about welfare in this setup? Well, it's actually, there's a way that works really well. And I've been actually working on another paper on using similar approach. I'm gonna advertise it briefly at the very end. But here, you need to come up with some kind of welfare criteria. So the one I'm gonna be using is the following. I'm gonna do the following. I'm gonna say, look, these people have this disagreement about the perceived payoffs of the asset. I'm gonna assume that the planner computes welfare using a different belief. So even though agents use those beliefs to compute their demands, the planner will compute welfare using different beliefs. Okay, of course, it's going to take us given the demand chosen by the agents, given their beliefs, but it's going to be looking at these different beliefs to compute welfare. And here, to be able to aggregate nicely, I'm going to assume that the planner looks at the sum of certainty equivalents. Okay, this is some kind of Calder-Higgs criterion in these setups. It's just to avoid the fact that when you have curve utility, you start to want to redistribute wealth and kind of trying to kill all the redistribution by doing this. So those are the two things I'm going to be doing. So conceptually, again, this is just a standard kind of assumption in models in which you have curve utility to be able to aggregate things in dollars. The key thing here is the use of the single belief. And this is in the sense in which the model is paternalistic. And, some people don't like this, and that's perfectly fine. It's, it's an assumption. So all the results are going to be driven by this result. And again, I want to address philosophical issues here. Personally, I think it's like, when you put a welfare function, you're also imposing weights on who gets what. This is a similar idea here. You're imposing the view that people are making mistakes, and you have the potential of correcting them. You will see that the nice result of the paper is going to come in a second, which is like, regardless of the planner's belief, it's going to be more of a consistency requirement than a practical concern. So the idea is that you will have to assume that there's a single belief. You won't have to know which one. And I think that's a nice result, one of the nice results in the paper. There's been other work looking at some of these issues. So let me tell you what the letters. This is the paper by Myers, Simpson, and Xiong. There's some work by, this is Sargent and co-author. There's some work by Gilboa, Samuelson, Schmeidler, more axiomatic. A lot of these papers, they've taken a bit of a different route. So what they try to do is they try to come up with some either more axiomatic criterion, or they come up with a rule to come up with a belief. That is fine. So my paper is fully consistent with those in that, you could potentially use this. I'm more just focusing on the question, like, given a belief, what happens? And these papers are more about how do you pick the belief. That said, the nice result of not having to worry about the belief is that, in a sense, you don't have to get into this debate under the conditions that I will characterize. Just to be clear, there will be conditions under which the belief will matter. So I won't tell you the belief is irrelevant always. I will tell you under some reasonable conditions it won't matter. But for example, if you go to the very non-linear case, which I will describe at the end, or if you go to models with production, which are somewhere in the appendix, the belief might matter. And then you may want to kind of start to think about some of these issues, okay? But that's kind of the way. There's been also other work this is work on self-control, in which people, have different selves over time, or this also work on behavioral taxation and so on, which actually sort of came quite after this one, but it's also quite related. So that's the idea. Okay, so let me start. Okay, I'm halfway through, so I'm gonna start with the results. Let me get started. So what is the optimal tax formula in this setup? Okay, so again, keep in mind, what I was doing is I was computing welfare, okay? And I was, again, looking at the utility of each person, but essentially, instead of using the belief they use, now I'm going to substitute the planner's belief, and I'm going to compute welfare in that setup, and then I'm going to look at how welfare varies when you vary your tax. So the optimal tax, tau star, is going to satisfy this condition. And it looks a bit complicated, but it's not that complicated. So what this says is like the optimal tax is the difference between two terms. Okay, the first term here, what is this? This is an integral over all the investors who are in the buying region. So this B calligraphic is the set of buyers. So I say, like, at a point in time, let me say who is buying. Let me integrate over all these people, and then let me look at their expected return. Okay, again, this is using their belief, and I'm integrating over the distribution of I types. So if you give me essentially the expected return of the buyers, that's what I'm going to get here. Now, it's not quite, because there's a weight, and that's what this omega weight is doing. So I need to do some weighted average of the returns. Okay, so this term is the weighted average of expected return across buyers. This term is the same thing, but I'm integrating over sellers. So I look at the sellers, I look at the returns, I compute the average of expected returns. That's the tax, and I have to divide by 2. This is coming from the fact that both pay the tax, but that's kind of the idea. Now, what are the weights? Okay, the weights are this object over here. So the weight is just saying, look at dx1 d tau is this general equilibrium elasticity. So it's like, if I increase the tax by a unit, how is the portfolio of these people moving? Okay, and this is the sum of all these elasticities across buyers, and for the sellers, it's the same idea. You look at the weight is the one for agent I over the sum for these sellers. These things are negative on the numerator and the denominator, but so this ends up being positive, but you see how these are weights, okay? Now, why do we get this formula, okay? And let me give a bit of intuition for this, okay? And then, again, the rest of the paper, I'm gonna push more into what's behind this, but why do we get this? Well, if you're familiar with Pigouvian taxation or corrective taxation, you may recall that Pigouvian logic tells you that you want to tax an externality. So the tax is always based on the size of the externality. Now, here there's no externality. It's all what's called often known as an internality. Okay, so the idea is the planner, if you have an externality, what the planner wants to do is correct the externality. Here, what the planner wants to do is correct the mistake that you're making. But the logic maps almost one for one. The planner knows that you're doing something that you shouldn't be doing. And the tax is going to be geared towards preventing you from doing that. Now, what is the planner perceiving to be wrong? The beliefs. The beliefs are perceived to be wrong from the planner's perspective. When the planner computes welfare, the perception is that you're making some mistake over there. So the reason why the beliefs show up here is because that's what the planner that's the difference between your perception and the planner's perception. So that's the reason why you get the beliefs. Now, you should be getting actually the difference between the planner's belief and the agent's belief. But because as I'm going to show you in a second, there's going to be a cancellation here that is going to make the planner's belief drop out. But I'm going to tell you why. That's going to be very specific to the setup that we are discussing here, which is, again, one of the main results of the paper. So the reason why you get beliefs is a Pigouvian principle. The issue is with the belief distortions. The belief distortion should be there in the optimal tax. Now, why do you get the elasticity is connected to the literature on Pigouvian regulation with imperfect instruments. And here, this is important, okay? So if you think about a first best policy problem, that I do this, again, it's also somewhere in the extensions. The first best here from the planner's perspective is to put an individual tax. Is to say, if you're very optimistic, I'm going to put you a very high tax. If you are very close to the planner's belief, I'm going to put a very small tax. But the planner cannot do that. The planner can only put one tax for everybody. And that is the reason why you get the elasticity showing up. So the idea is you give more weight, okay? The reason why you have this weight is you give more weight to the agents who are more elastic, okay? So if somebody were very inelastic, you put very little weight to the beliefs of that agent. And that is the reason why these demand elasticities, okay? I should call it equilibrium elasticities, okay? Show up in the policy because you have a second best problem. And this is an important idea. Actually, I have some, let me advertise another paper. I have some also recent work thinking, not in this context, but in a broader setup, how to think about some of these second best problems. But this is really why you get these issues. Okay, so I hope I gave you an intuition, and it kind of makes a little bit of sense. And I'm going to tell you a bit more in a second. But it's if you have a lot of dispersion in beliefs, okay, this thing is going to be very big. You have like people buying a lot with very extreme beliefs, people not buying, people selling with very pessimistic beliefs, and that's going to give you kind of a lot of volume. So that's going to be sort of driving this. But I will dig a bit more into this in a few slides. Okay, so this is the first result. Now, the second result is this is just the tax format. Just to be clear, this is a complicated expression because the right-hand side is endogenous to the tax. So this is not a solution for the tax. It's just a characterization. Like who is a buyer depends on the tax. The price potentially depends on the tax. The weights depend on the tax. So this is not a solution. It's not a closed form solution. It's just an intuitive way of showing you how what the tax should satisfy. Now, if I want to look at the sign of the tax, what I can do is tell you something about the slope of welfare for small tax. Okay, this is often the way to think about it. Okay, so if I have a result on how welfare looks at 0, and I understand that the problem is sufficiently well behaved, then I can tell you something about whether I have a positive or a negative tax. Now, what I can do is to actually characterize that. This is how social welfare from the planner's perspective varies with the tax when the tax is 0. And I can provide a condition on primitives that tells us whether you want to have a tax or not. And the condition is this one. So this condition is saying, okay, look at this tau 0 point. Imagine you have no tax. Look at the beliefs of the different investors, and then look at the F is a cross-sectional covariance. Okay, so you look across the population of people. You look at their beliefs, and you look at this object here. What is this object? This is something, okay, that has to do essentially on whether you are a buyer or a seller. So if you're a buyer, the tau is going to be negative. If you're a seller, the tau is going to be positive. So essentially what you do is you say, look, I'm going to look at my population, and I'm going to see if my optimistic people, the people when this thing is very high, are going to be buyers, okay? Which is people for which this whole thing with the negative sign is also positive. So if in the population, I see that the optimistic people are buyers and the pessimistic people are sellers, okay? then I want to have a positive tax. And that is the result. Now you may be wondering, why will not that be the case? Well, remember, I have made arbitrary assumptions on the other reasons for trade. So it may be that if you can be very optimistic, but you may be a natural seller of the stock because it's actually very bad for your hedging. Okay, one example that people have identified often is, for example, when you own shares of your own company. Say I work in a company and I have shares. My labor income is going to have, the stock of that company is pretty risky for me. So I should be shorting from a hedging perspective the shares of the stock, okay, of the company, okay. So if you have an endowed labor income in a company, you don't want to take on more risk. What happens quite the opposite, actually. People tend to be more optimistic about the company in which they work. So that would be a case in which you can have an optimistic seller, in a sense that you're selling for good reasons, but you should be selling, I don't know, 10 and you're only selling 5. So in that case, that will kind of push the planner to give you a subsidy, okay, not to put a tax, okay. But what this condition is saying is, like, if you look across the population of investors, and what you find is that optimistic people are buyers, and pessimistic people are sellers, you're gonna be going for the tax. Now, this is the second result, which is building on this. Actually, the hardest to prove of the paper, which is like, if you have some people with heterogeneous beliefs in this economy, and the fundamental and non-fundamental trading motives are orthogonally distributed, this condition will be satisfied, and tau star will be positive. So what I also proved is that if these reasons are independent of each other, then this thing will be satisfied endogenously, and the tax will be positive. Okay. So I hope I walk you a bit through what the intuition is here. Orthogonality plus the existence of belief-driven trades implies that the tax want to be positive. And this is, I would like to emphasize, this is really important because it's regardless of magnitudes, okay? So I want to make this point clearly here, which is even if the amount of belief-driven trades is very small, and you have a ton of fundamental trading, the tax will be positive. It may be very small, so it may still be very small. But as long as there are some belief-driven trades, the tax will be non-zero. This is something that I explain in a bit more detail in the paper. But the idea is, like, in this setup, there are going to be first-order gains, well-free gains from reducing the distorted beliefs, but there will only be second-order losses from distorting the trades from the people who have, in a sense, correct beliefs. Okay, so there are always first-order gains from doing this, and I have a nice picture in the paper that I will be showing today. I have a question.
Sorry for interruption again. Yeah, so I think Martin has a question.
Martin, sorry.
Yeah, could you explain a bit better? So what is orthogonal exactly? So the endowments, or because I mean they have different.
Independent. It's actually, these are slides that are a bit outdated. It's independent of each other.
But I mean,
so the distributions are independent.
But under which belief? Because under the planner's belief, or
no. Just to be clear, the belief is independent from the other motives. Remember, as an agent, each agent is 4 numbers: risk aversion, initial position, a covariance, and a belief. So what I'm saying is the belief, and imagine we're in a classroom. There'll be a bunch of us, and what I'm trying to say, like, the distribution of beliefs and the other motives are independent of each other. So in other words, the fact that your belief is higher is not correlated with whether you have a high or a low hedging.
Okay. Yeah.
Makes sense? That's a very good clarification. Okay, so it's about it is about how the belief is assigned to different people in the economy. Thanks for the question. And if anyone else wants to jump in, this is a good time. Thank you, Martin. So that is the I hope it's clear. Thank you. So that is and this is in a sense this condition is intuitive in the following sense. The example I told you before of the hedging your labor income it looks like cooked. It's not very natural. If you're optimistic, you naturally will be a buyer, and if you're pessimistic, you naturally will be a seller. There may be conditions under which this is not the case, but they become a bit more, unusual. You need to kind of you need to construct a specific pattern of hedging and beliefs, and if you make them independent, it won't occur. Okay, so that's the intuition. Oh, and now the key result, you sort of got it, which is, again, it's already, you can see it here. The planner's belief doesn't show up, and I promise you, to derive this result, you need to have a single planner's belief. So why is this happening? Well, there are two assumptions that are critical, okay? So the first one is that assets have to be in fixed supply, okay? So the Q of the risky asset is fixed. And that is really important for this result. When I do the extension in which the Q can move, this will not be the case. It'll be another term that will capture production, and then actually the amount of the difference between the planner's belief and the average aggregate belief. So the average of the expected beliefs is going to matter. Okay, the intuition here is the following: you have investors that are trading against each other, and the extent to which they trade is driven by how different their beliefs are. So if it's between you and me, and you have a belief of 10, I have a belief of 5, this economy is going to have the same allocation. If you have a belief of 15, I have a belief of 10. So it's really the difference between you and me what's driving the trade. And what the planner cares at the end of the day is about volume and the allocation of the asset. Because just to be clear, in this setup, the only economic decision is risk sharing. There's nothing else here. There's an asset, there's no production. Welfare is coming from getting the portfolios right. Okay, and if you're too optimistic and I'm too pessimistic, we start to trade with each other, and then we get the portfolios wrong, in a sense, with respect to the pattern. So in the simplest case, that this is in the lemma 4 in the paper, is like, if we shut down all the other reasons for trades, imagine I make all of us have the same initial positions, the same risk aversion, and no hedging needs. If we only trade on beliefs, the planner will want to stop all trade. And this is kind of a nice property, or in my view, of this kind of theory, in a sense that it's like, what the planner is trying to do is eliminate this belief-motivated trade. Now, because, the problem is interesting because you have all the other reasons for trade. Okay, this would be like a trivial result to tell you, okay, we trade on beliefs, people don't want to trade on beliefs, you get it. The subtleties come mostly from the fact that you still have all this fundamental trade going on, and that's where the paper is more interesting. So all the results I told you, they're kind of driven by that. Like this result, the previous result, the optimal tax is really all driven by this. Otherwise, this would be a sense. But this is a nice kind of robustness check or nice sanity check for the theory, and to get this, let me just say once again, in this simple setup, it doesn't matter the belief that the planner uses. Okay, so if the planner uses your belief to compute welfare, it will kind of be accounting that I'm kind of really wrong. So when I avoid the trade, if the planner uses my belief, it's going to perceive that you're really wrong. And this also want to curtail the trade. And that's the idea I was saying about first order and second order. So if the planner uses my belief, the planner will perceive that I have very small losses from not trading. It will perceive that you have very big losses. And because you're weighting everybody's welfare here, this planner is eyeing up everybody's welfare. No matter which belief it's being used, there's always this push towards kind of no trade. Okay, again, if you have fundamental reasons, it's more nuanced, more subtle, but this is kind of what's really under this. Very briefly, I can also even skip this. This is the tax rate. This is the welfare from the planner, kind of normalized, and this is the way it's going to look. Okay, so if you put the tax, this is the marginal. So when it gets 0, it's going to give you the optimal tax. These numbers, I'll discuss them in a second. So I think 37 basis points is going to be my leading result, but this is essentially what I was sort of characterizing. I characterize what happens at the optimum, and a little bit, I characterize the slope here at 0, etc. Okay, so I'm running a bit slow. Let me just kind of walk a bit faster here. So this may not be that interesting to you. So the paper is, this problem that I show you, this is quasi-concave, which again, if you remember, quasi-concave just means you have a unique optimum. Okay, so it's not fully concave because actually at the end, welfare kind of goes up, but it's never going to cross 0 again. You can prove that. Now, I gave you a nice, well-behaved case. If something you should keep in mind is that this problem may have multiple interior optima. So here I could have multiple crossing points. Why does this happen? This happens because we have extensive margin effects. Okay, so the idea is that the following. Let me kind of try to show you this. I'm going a bit fast here, but let's hope I can give you the intuition. So if you look, imagine you have two groups here, and they have different beliefs and so on. Okay, and For one group, this will be the welfare. For the other kind of group type, this will be the welfare. Okay, so there are buyers and sellers in both groups, but they have a different perception. So what happens is once you aggregate them, if you add up this line with this line, you can get the green line. Okay, which is a world in which like this marginal gain is very high here, then it becomes really low, then it becomes high again, and then it crosses. So here it will be three potential. I mean, there are not three optimal taxes. There are three candidates. Of course, one of them will be the optimal one. But I'm telling you this because in economic terms, this has a very important implication, which is like, if you put a very small tax, you want to make sure you don't kick out the good people. Okay, so if you're in a world in which like a lot of fundamental trade will be kicked out with a small tax, for example, or maybe with an intermediate tax, and you only get like crazy people trading, you may as well just kill the whole trade in the economy. So there's this compositional effect coming from the inaction that really makes the problem a bit more subtle. This is just an observation. One thing that is nice is that if symmetry, which is the condition I told you before, holds, and there's a tail condition, which is in the paper, you can kind of write the optimal tax in a very nice way. So in that case, you drop the weights and you get this really kind of clean result, and it's all very nice. So a lot of the applications will look like this. Okay, so 2 points here. First, if you get symmetry, you drop the weights, and if you have a tail condition, you're gonna get a unique solution. So that's the idea. But in general, it did not happen. Okay, so now what is next? So I told you all these tax things. Now, this is a bit hard to implement in practice, let's say. Even this, I will need to know the beliefs of everybody. So what the next in the paper is like, how will you implement this in a different way? To do this, I derived this, I think this was new in the literature, besides the paper, is this volume decomposition, which is a result in which trading volume can be decomposed in a term about fundamental volume, non-fundamental volume, and the tax-induced volume reduction. I will not give you the terms because they are like a bit nasty looking, but if you can look at them in the paper, fundamental volume is something that depends on the difference in beliefs. Non-fundamental volume is something that depends on the difference on risk aversion, hedging needs, and so on. And this is something that depends on the tax rate. Okay. So if you do this decomposition, okay, I'm going to show you a picture later on, which you can kind of see it nicely. You're going to be able to have a volume implementation of the optimal tax. So the optimal tax star can be implemented, adjusting the tax until the trading volume equals fundamental volume. Okay, which is a nice result. So essentially, these are again nonlinear functions of the tax. But if you look at total volume and you make it equal to this, that's going to be exactly the same. It's going to be, so essentially, you compute this and this, you make them equal. The solution to that will be exactly a tax formula that I derived before. And this is a nice result, okay? This also means that the non-fundamental volume being equal to the tax reduction is what we were deriving before. Now, just one thing, this is not obvious at all because the Piguvian formula is extremely general, okay? It's gonna work in very nonlinear models. This result does require the whole Cara structure, okay? Because volume is an inframarginal object. There's no reason to believe this will be true. This relies more on the assumptions than the first result, okay? And the other thing that, people are always worried, it's like, oh, how can you look at this? Well, what I can also show you is that if the tax is small, the optimal tax must satisfy this kind of nice result, which is like, you tell me the non-fundamental volume share, okay, with no tax, you tell me the volume semi-elasticity, and I can tell you the optimal tax. So this is really a solution because the stuff on the left does not depend on the tax. This is computed in the laissez-faire. There's no tax. But if you had a sense of what is the fundamental volume, the non-fundamental volume share, and the elasticity, you can essentially approximate the optimal tax. And this is the back of the envelope calculation I told you before. This thing is 100, or the numerator is estimated to be 100. If you give me a share, you can translate things to 2 basis points. So this is another kind of nice intuitive results on why you're getting this. All right. So now let me give you the last part. Okay. Now, so far, all of these did not make assumptions on primitives. Now, what I do next in this part is to try to be a bit more quantitative. I'm going to make some assumptions. So what I'm going to assume is that the beliefs are going to have this distribution. They're going to have some average expected payoff across the investors. And it's going to be a normal here. Okay, it's going to be a mean plus some error term. It's going to be some hedging motives. There's going to be normal with some mean and some some error term, and then these epsilons are going to have this rho as a correlation. Okay, so that's the assumption. So asset holdings are going to be the same, risk aversion will be the same. So I'm going to just focus on hedging and beliefs, two motives for trade. And as we said before, to Martin's question, this is how they're distributed across people. Okay, so I'm saying if the rho is positive, this means that optimistic people have a high hedging need, which means they will be actually sellers. Okay, so that's kind of the idea here. And you have some, so the sigma squared D is the expression of the beliefs, sigma squared H is the expression of the hedging needs. And this share of non-fundamental trading is this delta is going to show up sometimes, is defined in the same way I did before. And actually here, I didn't put in the slides, sorry about that, but it just depends naturally on sigma squared D. And actually, if you have no other reasons for trade, it's just about the ratio of sigma squared D over sigma squared H. Okay, so some results you can actually prove here. If the beliefs, if there is dispersion in belief and the correlation is negative, then the tax is positive. This is a bit of this is a bit more exact than the one I showed you before. Before I show you that if this was positive and the correlation was 0, okay, then you get tau star. Now, when I specialize to normal, it's correlation, what's really giving me independence. And then I also can have negative correlation. So that's a bit of a more precise result under more assumptions. Second, the optimal tax is increasing in the ratio of sigma D to sigma H for any rho. Makes sense. If you have more belief-driven trades, the tax is going to be increasing for any correlation. Of course, a mean preserving spread means that sigma D is going to be higher. It's going to increase the tax. That's obvious, quite intuitive. And the final result is if this delta NF ratio is greater than 1, then you want to kill all the trade, okay, which can happen in this economy, okay? And you put an infinite tax because this is a normal. There's always people kind of going to the tail, so you will want to put an infinite tax. If delta NF is between 0 and 1, then you get a nice interior positive tax, okay? So if that's the idea. And if delta NF is negative, then you want a negative tax. So what does it mean to have a negative share? Well, I'm calling it share, but actually this delta NF could turn to be negative, okay? It's a nonlinear function. So it's not quite in between 0 and 1. I call it share because we always will be thinking about the case in which this is between 0 and 1, but actually it doesn't have to be the case. So that's the other result, okay? So here, before I give you very general results, these are a bit more specific once you allow for extra structure on the pattern on NOx, okay? And now in my last few minutes, I'd like to tell you how you will save your planner. You will actually implement this. How do you do it? So there's another result on the quantification side. That's the last kind of big theoretical result. It's really about measurement. It says the following. All you need to know, and just to be clear, this is given these assumptions. Okay, so if you make these assumptions, if you tell me delta NF, okay, which is the share of non-fundamental trading volume, and you give me the semi-elasticity of trading volume to the tax rate, I can tell you the optimal tax. This is a result that I showed. It's not obvious you're going to get this, but that's what you get. Now, just to clarify, this thing can vary with the tax, but if any level you give me, I will be able to compute the tax. So for simplicity, I'll look at it at 0. But if you give it to me at tax equals 0.3, I can also complete the tax. And delta NF is this ratio, okay, which in this model is gonna, you're gonna be able to compute this way. So for any value you give me, I can compute it. So this is quite nice. Just 2 numbers, I can give you the tax. And if you want to look at the marginal welfare impact, you need to also know this. You need to also know this, and you also need to know kind of the risk premium, okay, which is defined this way in the model. So the idea is to know the tax. I just need to know the share and the elasticity to, in a sense, look at, if I wanted to look at maybe like local gains or losses, you also need to allow me to translate this into valuations. And the risk premium allows me to do this. So that's the intuition. Okay, so how am I calibrating this? And again, this part you need to kind of take with a grain of salt, but that's what the model delivers. So risk premium, this is a quarterly calibration. So this, a 6% yearly over 4 quarters would be like 1.5. The share of non-fundamental trading, that's going to be my baseline number, is 0.3. How do I get this number? To all of this. So these are just my preferred numbers. This is, I think, a conservative number. Okay, and this is an open question in the literature. How do you measure how much volume is belief-driven versus not? People will not agree on this. Many people will think it's 90%. Many people will think we don't know, and maybe we want to be conservative. So I'm more of the conservative way of thinking. I think 0.3 may be reasonable, so I'm gonna run with that, okay? Now, the other thing we need to look at is the semi-elasticity of trading volume. And I'm borrowing from this paper. This is the Journal of Finance by Jean-Edouard Colliard and Peter Hoffman. And they look at, that's an empirical paper in which they essentially look at what happened. And what happened in France sort of is the following. They put a 20 basis point tax and volume went down by 20%. That's as simple as that. There are a number of estimates, okay? They have, it's from 10% to 40%, and it depends on, what stocks you look at and so on. But I think 20% is pretty much the kind of more like the kind of consensus number there. So that's why you get an estimate of 100 here. That's why you get this number. Okay, so this is what I'm going to be using as a benchmark, and I do some sensitivity, of course. And then in the model, it turns out that turnover is not independently chosen again, but it gives you 33% quarterly, which is actually consistent with what you get for in the U.S. stock exchange or New York Stock Exchange. You have 33% quarterly. Okay, so the churn is 33% in a quarter. It's around like 120% a year. That's fully consistent. Okay, so this is what the model will give you. Okay, so just now, if you, I'm doing sensitivity one at a time, so I'm fixing the other. Again, what really matters is this thing and this thing. It's not going to matter really for the tax. Okay, so with this delta and F and this elasticity, what do you get? Well, if I move delta and F, I was doing 0.3, but I move it, you're going to go from here to here. My back of the envelope number was, you give me the share, and I give you the number in here. So I said that 30% share should be 0.3. Well, that was an approximation, so it's 0.37. Okay, so you have this thing being convex. Okay, so I'm my back of the envelope underestimates. Okay, now if you get really close here, you're gonna get it right, because again, this is exact at 0. So okay, so for 0.1, it's gonna be around 0.1, 0.2, 0.2. For 0.3, you're overestimating a little bit. Okay, so keep that in mind. Now for the elasticity, well, it's not that surprising. If you have a very elastic market, you need to have a very small tax. Okay, so if you kind of go for a number like, I don't know, 120, 140, even 200, you're gonna have lower of the tax. You can kind of, I'll let you do this if you want to look at your own numbers. Okay, but this is what you will get. This also convex over here, but that's kind of the estimate that I'm using. Okay, and this kind of nice picture is the volume decomposition that I was trying to illustrate to you before. So using my theoretical results, which I kind of didn't quite show you, I'm using Xi because before I did with volume, turnover is just divided by Q. That's what the Xi means, but it's what I did, the same thing I did before. So turnover is this object. As I said, you have 33% turnover. It's gonna go down. I prove this, that volume goes down. And then if you do my decomposition, you can compute it at each point. This is what the paper is attributing to fundamental. This is what the paper is attributing to non-fundamental. So the two dashed lines add up. Let me see if I get this right. The three non-solid lines add up to the blue line. So if you add up the blue plus the yellow, sorry, blue plus orange minus yellow adds up to the blue. Okay. So here, this point plus this point is equal to 0.33. You start going down, everything goes down, but then the volume goes up. So you have to subtract that. That's exactly correct. And then you can it's kind of nicely see that if what I call fundamental is equal to total, that's where the crossing point is exactly 0.37, where the crossing point is here is exactly 0.37. So you can actually look at this or look at that. One important point, and I'm going to conclude here essentially, is here it is not that kind of all the volume is fundamental in a sense. So it's how I done these definitions. There's volume there. It's just like the tax is soaking up part of the volume, and it's exactly the same as what I call non-fundamental. But everything is jointly determined. So you need to be a bit careful thinking about. Okay. Okay. Now in my last minute, let me not conclude. Tell you other things I do in the paper. I can relax the Cara utility assumption, and you get some. And I, in that setup, I also have like a consumption savings decision. So things get more complicated. But you get this nicely looking expression, which I didn't put here. It's in proposition 5, I think, in the paper. The insights are the key insights are the same. You get the beliefs, you get elasticities. So actually, you get a tax for the risky plus something that has to do with the risk-free rate with some weight that has to do with your sensitivity. But the really nice result, in my opinion, there is if you take the world, so you look for the optimal tax, you have this complex equation. But if you take the limit in which the stochastic discount factor goes to 1, because you take this kind of risk neutral limit, you recover the tax that I derived to you at the beginning. Okay, so you should be thinking about what I told you as an optimal tax with perhaps like small risks, or yeah, in which like, you know, the amount of risk relative to your risk bearing capacity is small. That's kind of one way, you know, carry utility approximates other utilities. So that's what you're getting. Okay, it's kind of a first order approximation. And then there are a ton of issues, you know, like I look into distributional concerns, what happened with the transfers, we talked a bit about this at the beginning. How do you think about having other trading costs? What if you have imperfect enforcement? How do you think about multiple assets? How do you think about dynamics, production? You get some kind of Q theory result. What happens if you have short sale or borrowing constraints? Actually, one can think of setting up this also to curtail trade. That may be an interesting thing, and it's not kind of quite explored in the paper. And then I also look at the first best. Okay, one thing that I want to emphasize, I don't know if you've worked on this, so there is also a body of work that thinks about learning, and there's no learning here in this model. So I have another paper which actually was written after this one, but it's already forthcoming, and in which I explore this with my co-author Cecilia Parlatore. In that paper we explore the role of trading costs on learning and information aggregation. But you know, it's a very different setup because there, you know, we shut down all this belief-driven rationale for taxation. That paper is more about thinking what happens with information aggregation when trading costs change. And if you're interested, you should take a look at that one. And this is, you know, this is what I did. I give you this formal analysis. You know, I went over all the details. Okay. More broadly, you know, the paper is really thinking about this analysis of transaction taxes with belief distortions. And this other paper I wanted to mention is this recent work thinking about other issues like, you know, prudential policy, like leverage regulation with distorted beliefs, but it's driven by similar concerns. Okay, you know, after all this time, now after all the GameStop issues, I felt that the paper could have, you know, used some of those issues to motivate maybe some of the paper I'm showing to you today, because part of that is really, you know, kind of crazy speculation, and you know, I don't think transaction taxes were quite discussed, or some people actually mentioned them, but it's something that, you know, if you had many more transactions, I mean, if you had transaction taxes, this type of crazy trading spirals could be curtailed. So it's, you know, it seems that, you know, the paper was maybe a bit too early for that. But thank you. Thanks for the comments.
Great. Thank you. Thank you very much for the very interesting talk. So do you have any questions or comments? Yeah, Martin, please.
Yeah, thanks a lot for the talk. I have a couple of questions. So the first one is this welfare decomposition. So you said that you basically always have a sign that because of the tax, the volume is reduced. So is that only true if the optimal tax is positive? So in the case that the optimal tax would be negative, so these weird cases could actually be the volume goes up by the tax? Is that not possible?
No, yes, that's a good point. So yeah, I don't think I qualified this. Of course, I meant when the tax is positive. When the tax is, when you have a subsidy, in fact, the equilibrium is not implementable in the following way. So you can solve for it, but in practice, the problem becomes you can have wash trades. I imagine you may be familiar with this. So it's like if you make a subsidy and there's no other restriction, what you want to do is trade infinitely. Okay, like you could start to like back and forth small trades, and that will not be implementable in a sense. So almost by construction, you should be ruling out subsidies here in practice. What you can do in practice is to say, look, the subsidy is over a unit of time. So, or like, I'm trying to make the following point. A subsidy to any trade is not implementable because the optimal solution is just this back and forth continuous trade. If you say that you put a subsidy over a change in your net asset position over a day or a minute or a year, that will be implementable. And you can kind of maybe interpret the model that way. But in that case, of course, the result I mentioned is not true. If you put a subsidy, volume goes up like that.
But actually, my question was, I think I meant something slightly different. Namely, the optimal tax is not positive, but you still take any other tax which is not optimal, sort of. Do you know that necessarily for a positive tax that the volume goes down? Is that always?
Yes.
Even
volume always goes down. Yeah, I mean, like, this is nothing to do with the welfare, right? This is purely a positive property of the economy. That only has to do with the demands of the agents. And if you look at that, actually, it's quite spelled out in the appendix. But essentially, think about it here: your portfolio. So dx d tau, your portfolio allocation as a function of the tax has two components. Okay, if the tax goes up for you, you have a direct effect. Okay, which is the demand that I show you. Remember? That always pushes you towards trading less. And the only thing that could make you trade more is a general equilibrium effect, which is like the prices move and then you have this kind of crazy effect, income effect, or something that pushes your trade the other way. Now, in the Cara setup that I told you, this cannot happen because you can actually show that the second effect is never strong enough. In the very, very general case, with like crazy utilities, like general utilities and everything very, very general, I'm pretty confident you could construct an economy under which I put a tax and volume goes up. Now, it will be a bit of a weird economy, I think, or if it's kind of purely valuation, like if it's only coming from prices, that will have to come from very strong income effects. And that will be just a bit of a weird economy. If you have other setups like information or other issues, I think that would be more plausible. But in the kind of environment, what I have, definitely that's for sure you'd never get it. With Cara, with other utility, you might get it, but I think it'll be a little bit weird. If you change your setup with information, you could definitely get it. I think that could happen. But again, also you need to, there's always a very strong effect. If I put a tax, you trade less. And that's kind of always gonna be there.
Thank you.
Thank you.
Thanks. Any other comments or questions?
Yeah, actually, I have another question.
Right.
Yes,
yes,
this is you mentioned at the beginning tax avoidance. So would you model this as sort of a fraction of the agents only pays part of the tax or no tax at all?
No. For that, mostly, I mean, the agents can trade somewhere else secretly. That's how I have it modeled. So imagine that I have to actually, we use this maybe pretty close to isomorphic, but you have two venues for trade, and you have this venue and you have another venue, and then you could, like, a fraction of your trades. It's a thing, actually, probably formally almost identical to what you said. A fraction of your trades can be made somewhere else. Actually, it's the same thing that you suggest. I think mathematically maybe look the same. So yeah, it's the same. They only pay so the thing is the following. It's a bit of a subtle difference. It's like, it's not like you. Yeah, I guess. Let me think for a second. My preferred way of thinking is part of the volume can be done somewhere else. Okay. And then in that case, what the planner does is the planner wants to shave, to kind of push downwards the tax. And this is a result that, again, this paper I mentioned I've been working on like second best policy is another form of second best policy in the following sense. Like, think about it. If the planner cannot if the planner cannot really target at all, cannot reduce volume at all, it's better not to have the tax in this setup because this is essentially ineffective. So to avoid these trades kind of moving somewhere else, what the planner does is lowers the tax a little bit. Okay, so that's one idea, and this is actually really important in practice. Okay, so the number I give in the paper should be thought of as a benchmark from which you need to kind of lower the number, because what happens in practice, the Swedish experience, for example, in the 90s was very remarkable, in which, like, essentially they destroyed the stock market. The volume went down 90% because they put a tax in Sweden, but then people would just went to London to trade. And that is a case in which, like, it's kind of just becomes silly to put a tax when you have so much kind of leakage to somewhere else. So that's what I mean by avoidance. That's actually very important. actually in the revision of the paper, I may do a bit more work on that because it came up as an issue to discuss further. But yeah, it's very important. So I see this more as a benchmark for no avoidance case. But I don't think that we have great. I mean, again, we have there's this experience. There's like one number which tells you that if you are the only country who puts the tax and your next door neighbor allows you to trade the same things for no cost, you may have huge avoidance. Now, if the whole EU decides to put a tax, I think that's maybe you may need to, that's a world in which you don't have that much avoidance, right? Well, of course, again, if it's going to migrate to London, it's now not part of the EU, but it's like, if continental Europe doesn't not London, if the trade migrates to London, that's a bit of an issue. But if everybody agrees, if they refer to a global tax, which will never happen, I think that will make things a little bit different. You need some coordination there. Although, of course, people will just trade secretly, or they will like find new venues. So it's kind of important to account for that. So in practice, that may be the main reason why you don't want to put a tax in this context, which is just it's too easy in financial markets. It's too easy to avoid the tax, and yeah, something that the paper is not considering.